Today, the precious metals market is not just moving, it is sending a message, and that message is being ignored by far too many people. Gold and silver are no longer behaving like ordinary commodities. What we are seeing right now is a structural shift, not a short-term spike, not a headline-driven reaction, but something deeper that reflects stress inside the global financial system itself. This is not about daily price charts or flashy predictions. This is about understanding why this moment matters. Thank you for being here and for giving me your time. Time is the most valuable asset any of us have, and I do not take that lightly. We are going to move slowly, clearly, and logically through what is happening because the noise level right now is extremely high, and clarity is rare. If you stay until the end of this video, you will understand why volatility has exploded, why physical metal is suddenly so important, and why the silver and gold markets are behaving in ways most investors have never experienced before. Let's start with what everyone sees on the surface. Prices are moving fast. Silver is swinging violently, gold is pushing against key psychological levels, and the daily ranges are far wider than normal. But price alone never tells the full story. Price is just the final output of deeper forces. To understand those forces, we have to look at how the market itself is structured. In a normal commodity market, futures prices trade above spot prices. That difference reflects storage costs, financing costs, and time. When futures are higher than spot, the market is saying supply is available and delivery is not a concern. Right now, we are seeing something very different. In multiple places, spot prices are trading higher than futures prices. This condition is called backwardation, and it is extremely rare in precious metals. Backwardation is not just a technical detail, it is a warning signal. It suggests that immediate physical demand is stronger than confidence in future supply. In simple terms, it means buyers are willing to pay more today than they are willing to promise for tomorrow. That is not normal behavior in gold and silver markets. When it happens, it usually means something is broken or under extreme stress. This raises an uncomfortable but unavoidable question. If the spot price is higher than the futures price, are market participants fully confident that physical metal will be delivered when contracts expire? Even a small doubt about delivery is enough to change behavior dramatically. Markets run on confidence, and when confidence cracks, volatility explodes. Now let's talk about volatility, because this is where many people get confused. Volatility does not mean failure. Volatility is not the enemy. In fact, volatility is often a feature of strong bull markets, not a bug. There is an old truth in investing that remains true across decades and asset classes. Strong markets do not move smoothly. They move violently. Think about it this way. A true bull market tries to remove as many participants as possible before it continues higher. It does this by creating sharp pullbacks, sudden drops, and emotionally exhausting swings. These moves shake out people who do not have conviction. They reward patience and punish impulsive behavior. This is how markets transfer assets from the impatient to the prepared. History gives us countless examples of this pattern. Every major repricing event in real assets involved periods of intense volatility. Calm markets rarely lead to historic moves. Discomfort is part of the process. The problem is that most people are trained to interpret discomfort as danger rather than as information. To understand why this moment is different, we need to zoom out. Not months, years. Silver and gold did not suddenly become important. They were ignored for a very long time. Capital flowed elsewhere. Investment dried up. Mining supply stagnated. Exploration slowed. At the same time, industrial demand quietly increased. Technology, energy, defense, and infrastructure all began consuming more silver year after year. This mismatch between supply growth and demand growth does not resolve overnight. It builds pressure slowly, invisibly, until suddenly it becomes impossible to ignore. What we are seeing now is that pressure releasing. One of the most critical and least understood aspects of today's silver market is the difference between paper trading and physical reality. On paper, silver can be traded endlessly. Contracts change hands without metal ever moving. This creates the illusion of liquidity and abundance. But paper silver is not physical silver. Recently, the paper-silver market traded volumes equivalent to multiple years of global mining supply in a single session. Let that sink in. More silver was traded on paper in one day than the world produces in years. That does not mean the silver exists. It means claims on silver exist. This is not sustainable forever. Paper claims only work as long as most participants never ask for delivery. When even a small percentage of participants decide they want the real metal, stress appears instantly. This is why backwardation matters. This is why volatility matters. These are symptoms of a system being tested. Now let's shift focus to where physical reality matters most. Asia. In markets like China, silver and gold trading is far more directly connected to physical delivery. The Shanghai Gold Exchange operates under rules that require real metal to change hands. There is no infinite paper loop. You either have the metal or you do not. Today, physical silver in China is trading at a significant premium compared to Western spot prices. That premium is not theoretical. It is real money being paid for real metal. This creates a powerful incentive. Metal flows toward higher prices. It always has and it always will. This is why silver is being described as a vacuumed commodity. Supply is being pulled toward regions where physical demand is strongest. When that happens, Western markets feel pressure, inventories tighten, delivery timelines stretch, confidence weakens, prices respond. What we are witnessing is not a local event, it is global. This is not about one country, one exchange, or one group of investors. Silver and gold are global assets, and their repricing reflects global forces. Another important point that is rarely discussed clearly is the difference between retail noise and institutional reality. You may hear reports that local coin shops are quiet, or that retail buying is mixed. That information is incomplete. Retail demand is only one piece of the puzzle, and it is not the most important one. Industrial demand, sovereign demand, strategic stockpiling, and international arbitrage matter far more at this stage. Online bullion dealers experiencing delays, inventory stress, and extended shipping times tell a different story than isolated anecdotes. The market is tightening, even if it does not look dramatic at street level yet. We also need to address the emotional aspect of this market. Fear and excitement often coexist during major transitions. Some people are predicting extreme prices. Others are calling this a bubble. Both extremes miss the point. The point is not exact price targets. The point is direction, structure, and sustainability. When real assets reprice after long periods of neglect, the move often looks unbelievable in hindsight. People later ask why they did not see it coming. The truth is, the signals were always there, but they were quiet and uncomfortable, not loud and obvious. This moment is about trust. Trust in currencies, trust in financial promises, trust in systems that rely on leverage and paper claims. Gold and silver do not promise anything. They do not yield. They do not default. They simply exist. In times of confidence, that simplicity is ignored. In times of stress, it becomes priceless. It is important to say this clearly. This is not about panic. Panic leads to bad decisions. This is about awareness. Understanding the environment you are operating in allows you to respond intelligently rather than emotionally. I am not a financial advisor, and this is not financial advice. Everyone must assess their own situation, their own risk tolerance, and their own goals. But history does offer guidance. Every time real assets have been dramatically repriced, the move was preceded by denial, confusion, and volatility. Volatility is not the end of the story, it is the middle. As global demand continues to collide with constrained supply, as physical premiums persist, and as paper markets strain under their own weight, the role of silver and gold continues to evolve. They are no longer just commodities. They are signals. Signals of stress, signals of transition, signals that something beneath the surface is changing. The question is not whether volatility will continue. The question is how prepared people are to understand it. Stay informed, stay patient, stay rational. And remember, markets do not reward comfort. They reward understanding.